Welcome, traders, to After Hours at Traders Post for Friday, February 13th, 2026. I'm one of your hosts, Peter Bad Trader Guru Hartman, joined by Tom Sacred Prophet. You see, that's the problem. Joined by Tom Sacred Prophet, Prop Firm Payout Poppy Hartman.
You got it. You got it.
I don't like it.
It rolls off the tongue.
To break down the market madness. And madness indeed was here today. After Hours is your weekly look back for retail traders where we break down what actually moved markets and how the cleanest trade setups played out or didn't. Tom will tell you about how it didn't. We hit the macro drivers when it matters behind the week in dollar, equities, and policy terms so that we have an idea of what to look for in the week ahead. After Hours is brought to you by BluSky, the best-in-class prop firm with same-day activation, daily payouts, and no max restrictions. But we'll tell you more about them later. Tom.
You have to forgive my little brother over here. He is new to reading. He'll get to it. You'll figure out. It's the R's are a little bit hard. I can understand that.
I'm not the little brother though.
Sorry, you're not?
I'm the older. I'm the older brother.
I don't know. You seem like the little brother to me.
So, okay, all right. You want to go there? You want to attack me? How did your trading go today?
Oh, I think my headphones aren't working. You might have to do the show solo.
You had an amazing trade yesterday. My goodness, you're flying high.
You're right. I did. I heard that. I heard that.
Yeah. So today, well, how much you up today?
Today, I had to pay tithe to the market. The market had another lesson to teach me. This is one of those moments where when I look back on it in my memories, what I'm going to see is just one pair of footsteps in the sand. Why? Because the market was carrying me. Because they needed to show me what to do next. Peter, it was a choppy session last night in the overnight, which is where I usually like to trade. I traded in the overnight. And during the day, oh my God, it was Porcupine City, just pin cushions all over the place. If you want to pull up the chart over here, we will see it. Just wicked crazy. Now, it's crazy to see this in retrospect, Peter, because I don't want to say it, but I was right.
Well,
let me just back up here. I said what I've been saying for weeks is the type of trade that I look for, the type of setup that I'm looking for any given day, especially for the U.S. Open or whatever, when futures open, is that I'm looking for the price to retrace back to the unmitigated VWAP level. Unmitigated VWAP level. We saw this yesterday where, actually, we just take a look at it today, but it happens all the time, where the market opens at 6 p.m. Eastern Standard Time. Oop, I don't have my marker over here. Let me see if I can get it. Market opens at 6 p.m. Eastern Standard Time. And I generally look for a setup in order to get the move up to whatever the closing VWAP price was from the day before. Now, there are two VWAP level prices that I pay attention to. One is the session VWAP, which is from 9:30 a.m. to 5 p.m. on U.S. Open. That's over here where it closed out. And then the overnight one, which is over here. And wouldn't you know it, price went right up and hit that mark. Please tell me that doesn't look like the price wanted nothing more than just to go kiss that line and pull back down. Tell me that's not what it looks like.
It's what it looks like. So you must have made a lot of money on that trade.
No. You see, what happens is that I can't see this happen beforehand. Trends in trading, from what I found in the NASDAQ, happens only at certain times. And that's near open and then like every 2 hours. So every 2 hours, you can get it. So at 8, at 10, at 12, and so on. So in the morning, I'm expecting the trend to start at 10, at 12, or at 2. Now, this trend started directamundo at 10. But if you notice beforehand, we had Wick City. There was the news at 8:30 for shoot, what was it? Was it CPI information?
CPI.
And then wick. If you guys take a look even at the 2 hour, you'll see it even more diligently, even more clearly. See this doji candle on the 2 hour? We all know when we see a doji like that on the 2 hour, it means someone's getting messed up. That is all over the place. The price is moving. So because I was looking for that trade up in the overnight and then an open, and it usually happens before that point, or often happens before that point, I got chopped up throughout this whole area over here. But I've learned my lesson. Because
what lesson is that?
Well, I am very good at determining trend. I mean, scary good at determining trend.
Okay.
No, like literally every single day, you could set your watch to Tom about how good he is at, hey, this is the trend for the day, and this is the level we are likely to reach. It's the path dependency there that's the problem. It's the way there. That's the problem. That's me doing a little bit of a Biden. It's the way we get there. That's the problem. No, that's a little bit of George Bush Jr.
You got to do the whisper for Biden, and then followed by a very loud sound. You're like, the market is trying to talk to you. Are you listening?
I'm not kidding. It's not joking. So I have to pay attention to what this chop looks like. Now, I know Mike from Price Action Live, Mike, the person who I like way more than Peter, on Price Action Live, he has a choppiness index. He has a choppiness indicator to let him know, are we headed into the chop? And he also has, he uses ATR in order to figure out what's going on over there. The problem I had with ATR is if you take a look at ATR, let me just pull that up over here. Yeah, ATR was higher in open, right? And first of all, ATR always rises during the US Open, so that happens all the time. But it was particularly high, right? As far as ATR goes. But you can have high volatility and still a narrow range. And as you can see from these candles, so it's a bunch of actual movement that's happening, but the actual range gets pinned. And so I have to pay closer attention to that. I usually have a rule that if the VWAPs that open during US Open, you see here how this is red line here and red line here. That's the overnight VWAP and then the session VWAP starting. When they're narrow, it means that you're going to have some chop that day, generally speaking. Plus, had I really been paying attention to it, I would have seen that throughout the day they're narrowing. And then when this cross happens, very often this is the perfect setup for Mustang Trader, one of the most profitable prop firm traders we've ever met. He's been on Price Action Live many times. He has a YouTube channel, Twitter account. Go check him out. But he put me onto the straight
on alphas as well.
Yeah, he's an interview on alphas. Very, very great guy. We're going to have him back next week. When the cross happens and those two VWAPs cross, the session VWAP and the overnight, this is one of those crosses that he looks for a trade, and that was a perfect time for the long. It happened right around 10 o'clock, and that would have been time in order to go long. The thing is that it happened to me on this candle, on this red candle. So because ATR was high, it was I got whipsawed in there. What I should have done was just placed a limit order on VWAP and then get filled here, give myself enough room. I should take this from Mike, where if I'm in high volatility, my normal stop is pretty small. But I can't have small stops when you have high volatility. Either have to be willing to have a wider range for the stop, or I have to not get into the trade because I'm going to get stopped out. And I got stopped out again and again and again and again and again and again and again.
Yeah, so that's what I don't understand. If you're willing to be stopped out, 4 or 5 times, you have a stop loss $75 away from your entry. Instead of having $75 away, just have 300 away.
You're right. I actually did a back test on this the other day. Let me see if I have it here. Where, so if given a $800 buffer,
800.
If I give myself an $800 stop loss on that trade where I'm trying to get this trade up to take profit here, so this trade up to over here, which happened today. If I allow for that, and if I only did that trade every day, every day where there was a, let me see here, is there a minimum? If there's a minimum distance, a minimum profit of $100 I can have, and I allow myself an $800 stop loss, if I did the trade every day, I'd have a 73% success rate on that trade. A 73%, yeah, 73% success rate. A bunch of these other ones are some bad results. I'm not trying to pay attention to that. What I'm trying to pay attention to is how often price actually gets to my trend target. If I give it enough room. The problem is I don't want to give $800. Like, I don't want to give $800 in one shot, which is sort of silly. Like, I gave back more than that, so I should have just done that. So I'm gonna learn that more for the future. Like, what am I willing to lose if I'm willing to take this trade 5 times and I'm only aiming for this one thing? Then give it the right range. But we'll see. But that was for trading on MNQ. All kinds of other things happened today. What was interesting was that the market's just been going down, right? We had this big drawdown over the end of January and in February. And even though we had this bounce back up, we've had what looks to be a continuation of the drawdown. If today is any indication, the bounce over here wasn't even a bounce all the way back up to overnight VWAP. It was only a bounce up to VWAP, and we pulled down lower. So chances are where you might head lower still. We'll see. Because when markets open on Sunday, the price right now is right where the VWAP levels are going to be.
What's the dollar doing?
Well, when we take a look at the dollar, we also saw it go sideways. We saw the dollar go sideways here. So the dollar has pulled back from its higher bullish trend. It bounced on the weekly unmitigated VWAP level, and now it's back up. So we'll see what's going to happen. But for the last few days, it's been a sideways chop, which is why we've been getting chopped inside of markets as well. But what's interesting is that Bitcoin actually did a bit of a rally off the lows. We have a rise of about 5 to 6% off the lows, while the equities are going down. So it lends to this idea that, hey, maybe we're entering into this inverse correlation thing, and the risk is moving off from equities because equities were pretty high. Maybe they're moving off into Bitcoin. And if we even take a look at the gold also didn't recover its all-time highs. And silver, if we take a look at silver here, we're noticing it's still down at $77. Like it's not even going back up as high as gold is, right? So silver fell from its high of a 122 or whatever it was, and now it's down, and who knows? We don't know if it's going to be a floor for it, or if it has more to go. Because if we take a look at silver on the daily, we'll notice here. Let's just go to logarithmic. It still has. It can go all the way down to $60 and still be on trend. Heck, it could go to $53 and still be on trend. So there could be a lot of reversal left for here. So we saw a pullback in commodities, pullback in S&P, sideways in the dollar, and up in Bitcoin, which was interesting. And then the final thing was in bonds. Bonds, we had a pullback in yields from all over the curve, from the short end of the curve, which is these warmer colors, all the way to the longer end of the curve, which is falling even faster. And when all bond yields fall, that generally means deflationary, right? Bond yields are falling because people go, the bond issuers have to offer less and less of a premium in order for you to buy those bonds. It means the demand for bonds has increased. Why are demands for bonds increasing? Because it's sort of a flight to safety, a desire for dollars in the future, a deflationary environment, whatever it is. Okay, so does the market look like it's showing a healthy thing for the economy? No, it doesn't. It does not indeed. Now, I want to touch a little bit. I want to go more in depth as to what's going on with global liquidity and Bitcoin, because I find the conversation now about Bitcoin, hey, have we bottomed? Was 60,000 the low? Are we going to get God candles now, or are we headed lower? I think the conversation is super, super interesting. And I'd love to touch on that. But let's get back to that after a quick word from our sponsor.
This episode is brought to you by BluSky. If you're looking for a prop firm built for real traders and that's automation friendly, meet BluSky. And when you pair it with Traders Post, it just clicks. BluSky is a best-in-class prop firm with same-day activation, daily payouts, and no max restrictions. They also offer launch plans starting at $49. And if you're a first-time subscriber, use coupon code WELCOME26 to get 50% off your launch plan. Get funded with BluSky, execute with Traders Post. Sign up today at blusky.pro, that's BLUSKY.pro, and plug in your edge. Trading involves risk. Use proper risk management.
I want to remind you all out there watching that the midnight VWAP indicator is available right now on the Traders Post dashboard. So you go to traderspost.io, log in, you click on accounts on the left side, then indicators, and all of the indicators are there. Midnight VWAP, there's in top right corner. This was a indicator that's created by Tom. All the indicators that Tom creates on Blueprint, which is a show that we do here on this channel every Thursdays at 3 p.m. Eastern Standard Time. Indicators, strategies, utilities, coding, AI, it's all available here. You can also get the PineScript agents that Tom has created to use along with Cloud Code on the GitHub right there as well. So traderspost.io, account indicators. You can even get that even if you're on the free tier of Traders Post. Go ahead and get that now. If you like what we're doing here and you like what we're offering, I highly recommend that you like the video and subscribe to the channel because we have more to come. Pay your like tax, folks. There's a tax. You got to pay it. Pay your taxes. It's a like tax. Let's do it.
All right. So last week, if you remember, I showed you a post that was talking about the idea that Bitcoin's 21 million cap is sort of like bunked now because of all the products that exist, all the financialized products that exist on the market right now. I wanted to play this clip from Jim Bianco from Bankless, who sums it up really nicely and goes a little bit more into depth. I thought he did a great job explaining it to these guys. Keep in mind, Jim Bianco was like being considered as a governor for the Fed. So this guy's no slouch. He knows about these things. All right, let's take a look at what he has to say.
We all talk about that Bitcoin, crypto, ETH is deflationary as well, is hard money. You can't print it. No, you're right. You can't print it on chain. You can't create more than 21 million Bitcoin on chain. But off chain, what we've effectively done is we've created a fractional reserve system around Bitcoin. So we've got the ETFs. We've got borrowing by, say, strategy that's been borrowing in the TradFi markets to buy Bitcoin. We've got structured products that are tied to the ETFs, which is tied to the underlying Bitcoin. So what we're doing is we're creating many, many billions of dollars of crypto buying that is not on chain. It's not unlike what we call the paper gold market, the paper silver market, versus the physical market as well. It's not unlike what we do with the stock market, where we have derivatives, options and futures and total return swaps and the like in those markets as well. The difference is with crypto is it's new. And the history of fractional reserve systems like that, where you're basically leveraging yourself up and kind of creating more synthetic supply. And the reason I say synthetic supply was it's not on-chain supply. It just mirrors the on-chain supply, is that these systems are inherently, these fractional reserve systems are inherently unstable. That's why over hundreds of years with banking, we've got the Fed, the FDIC, the OCC, the Treasury, the SEC, the CFTC. We got to have these overlapping regulators to take this very unstable system and try and hold it from blowing up. And we've got generations that we've kind of made mistakes, have had blow-ups in these markets, learned from them and adjusted. Crypto is new with this kind of synthetic stuff. And I think the real catalyst for this in a big way was, yes, we had futures and options, from the crypto exchanges, from the centralized exchanges forever, like the Binances of the world. But what really changed was these digital asset treasuries in the ETFs. And now you've got a representation of crypto in the TradFi world Now we could put options on that, futures on that, total return swaps on that. We could borrow structured notes on that. And we've got billions and billions and billions of dollars of people that are invested in playing crypto and never touching on chain. And so when the market started to crack, I think it was the synthetic markets that cracked.
I find this super fascinating, Peter. The idea here is that two problems. One, the Michael Saylors of the world, who create a tool to be able to trade Bitcoin without being on Bitcoin, actually subdue the bull market. Right? You're like,
they took
hey,
the money out. Yeah.
because the money's going there. Plus, he makes Saylor will make the claim that it's the volatility of Bitcoin is one of the three things that makes it worthwhile, right? That you have the volatility, so you can have performance, and so it becomes attractive. But the MSTR, the stock, is more volatile than Bitcoin, which he also says is a benefit for the stock. But then if I can get the volatility from there, and what I want is volatility, why wouldn't I just stay in the derivative space on MSTR? Why would I come to Bitcoin? Why do I want to go through all the hassle of dealing with Bitcoin if it's easier to get the volatility that I want over there?
Of course.
The price performance I want over there. But then as people do that, then the volatility of Bitcoin decreases, which then decreases the attractiveness of those derivatives, which then could cause them to crash.
Oh my
And then the
God.
crash of those derivatives then could cause the price of Bitcoin to fall. But this all adds to the reason why I personally think that the bear market for Bitcoin now is going to be the shortest and shallowest we've ever seen. Right? Let me add on top of that here. I think there was a post here.
Wait, so if we flesh out Michael Saylor, then they are right.
Well, it's not just Michael Saylors of the world, right? It's
Yeah,
all,
but
it's
if
all
Michael
kinds of stuff.
Saylor goes down, that's the first domino for all these other derivatives to go down. Isn't he the Pied Piper?
No, I don't think so.
You don't think the ETFs and the other derivatives, they kind of like people stop being interested in them?
I don't know. I think about, we even know people who are like, what they really focus on is the ETFs. They're not really buying calls and puts on MSTR. It's really the ETFs that takes a lot of the stuff, and then any custodial anything. So
Yeah, I just mean
no, I wouldn't.
I don't mean that they are trading MSTR. I just mean their interests, the energy behind it, is kind of being led by strategy, and if that goes away, then the excitement of being in the ETF may also go away. No.
All I really know is that if this 21 million Bitcoin is not a constraint causing this supply shock, right? That was supposed to be the whole idea. It's supposed to be a squeeze on the price because there's only 21 million. If that's gone, then all these value propositions for all these things have that as an underpinning. So if that's gone, then what's the value of Bitcoin longer term? I think there's value in Bitcoin longer term. Let's not get crucified here. I'm just saying, well, what is it? Because it's not
Right.
the supply constraint. But the work cases that people were making that was always going to be the biggest problem, that you get a rise up in Bitcoin and then a crash down because supply is constrained. But if the financialization of the asset creates a synthetic market that creates elasticity, well, all right.
I think Bitcoin, specifically crypto in general, what it needs is one great war. I don't see the financial system collapsing and people moving over to crypto unless there's a dire need to do so. And I don't see the dire need occurring unless absolute loss of faith in the American government, absolute fall of the euro. Like
I got something else for you. I got another potential path that doesn't require World War Infinity. Let's jump to that one right now. This is Charles Hoskinson on an interview with CoinDesk a little while ago, and he makes a great point that I thought was very interesting. Let's just jump to that. and take a listen.
I don't know if you have that
Oh,
on
wait,
screen
you're
here.
seeing it. 1 second. All right. Here we go. He's going to be talking about how crypto can be adopted and who else is coming onto the network.
And I fully appreciate and understand where the retail investor is at. Imagine you tell your wife, we're going to make all this money in this coin, and then you lose like 92% or 95%. Then you do it again, and then you do it again. Like, how many times you do that before you get divorced? It's not pleasant. So retail is kind of fatigued and done, and we need a fundamentally different way of approaching it. But I've seen it before with the first to second generation. During the first time, we had Litecoin and Feathercoin and Freightcoin and Peercoin, and they're all just forks of Bitcoin in their own ways, and slightly different monetary policies, still proof of work. And then Ethereum came and it radically changed the perception that everybody had. So when we look to the future, you have privacy, abstraction, and smart compliance. And it's talking about building one rules-based global market for everyone everywhere. And it's like going from black and white to color television. You have a completely new dimension to build in, and you have completely new applications, many of which are non-financial. We keep treating this like a financial product. And I keep saying this is the everything product, it's economic, political, and social. I want to get to a point where your Tinder runs on blockchain, and you can prove properties of how tall you are and how much money you make and where you're at. And you can actually verify that the picture in the Tinder profile is real.
On Tinder.
Yeah, it's very important. But I want to get there, and I want to get to a point where all the video games run on it, and a point where all your Facebook and your other things run on this infrastructure. That's what's going to bring 2-3 billion people in, and that's what's going to change everything. And the consumer doesn't care about that there's a token at the end of the rainbow, there's a blockchain at the end of the rainbow. I don't have to care that there's TCP/IP in the internet. I don't have to care how electricity works. I just flip the switch and magically it works. We got to do that as an industry, and we got to stop over financializing everything. Anytime I hear anything, I always ask, when's the token launch? And I'm sorry, 11 million tokens went out last year. It's not sustainable. Nothing is going to go to the moon. Get people in, solve real problems, the narrative will change. And then.
So I think that's exactly the sort of thinking, right? This the technology for
Sorry, go ahead.
Yeah, the technology for blockchain is what we've been wanting to see, and it got hooked into this financialization thing. But if that thing goes away, then we open up the doors to something else. So Peter, I did my first crypto project the other day. I gave it the documentation for a blockchain and what I needed to do, and I go turn this dollar system that I have within this app and turn it into a blockchain system that has privacy with Midnight and use Cardano native token and the whole thing. And I was able to plan out the token, deploy it on testnet, change my interface for it to work accordingly. And I go, wait a second. This is what we've talked about this whole time, this conjunction between AI and tech. Now, all the people who were in the blockchain space over the last 15 years who've gotten rich or wealthy or get notoriety because of the financialization of it, number go up, they really have no incentive in order to move and go do something else within the space, unless it's tangentially related to it. But then a bunch of us now, the doors have opened where we get to now be like, well, I have this idea and I'm not here trying to launch a new token. I just need this tool to work in a way that allows it to be permissionless on the blockchain, decentralized or whatever. And I want to create 50,000 things, right? The people can create 50,000 things on a network. That's the unlock here. That's where all of a sudden the transactions don't need to be so high. You don't have to have high gas fees or whatever. It could be a penny on any transaction, but it's running again and again and again and again and again and again for all these different people. And it's so easy to spin up so that you can have 8 different properties that you're running and it's generating $100,000 for you. And that's fine. It's okay for you. All within the blockchain space. So I think the next phase that we're going to be seeing here is this conjunction of that AI and the crypto, but not in the way that causes the financialization of it, but it causes new types of applications to be run and to be monetized without having to go through the normal institutional systems. I do want to play a quick video here from, this is one from Elon Musk. I just want to get this out there. He talks about this very real issue about the productivity that can be generated from these AI systems. So I just want to bring this in right now.
I call
AI and robotics, the supersonic tsunami,
Yes.
which maybe is a little alarming.
Good. It's good. Well, because the,
Like, I just
the
like
world
the
needs a wake-up
alliteration,
call.
right?
This is important for folks to grok, because I don't want to leave people depressed. I want people to understand what's coming. So we're basically demonetizing everything. I mean, labor becomes the cost of capex and electricity. AI is basically intelligence available at a de minimis price. So you're able to produce almost anything. Things get down to basic costs of materials and electricity, right? So people can have whatever stuff they want, whatever services they need. It's not, when we say universal high income, it sounds like it's a tax and redistribute, but that's not the case.
I think my best guess for how this will manifest is that prices will drop.
Yeah.
So as the efficiency of production or the provision of services drops, prices will drop. I mean, prices in dollar terms are the ratio between the output of goods and services and the money supply.
Sure.
So if your output of goods and services increases faster than the money supply, you will have deflation, or vice versa. So
It's a good thing we're growing the money supply so quickly then.
right. Yes, that's why I came like, let's not worry about growing the money supply. It won't matter because the output of goods and services actually will grow faster than the money supply, and I think we'll be in this. And this is a prediction I think some others have made, but I will add to it, which is that I think governments will actually be pushing to increase money supply, like
faster.
Yes, they won't be able to waste the money fast enough, which is saying something for government.
Isn't it crazy how close those timelines just randomly worked out? I mean, at the rate, because we're expanding the national debt, not because we're anticipating AI. We were going to do that no matter what.
Yes,
and it's like right on the edge of becoming Argentina.
But yeah, it's
right at the time that
the productivity is going to improve dramatically, and it is improving dramatically. I think we'll see. I think we may see high double-digit output of goods and services. We have to be a little careful.
So can you imagine that? Can you imagine double-digit GDP? So this is the future. It's like, how do you even price this in? If the idea that productivity can increase dramatically, that means, so he's basically saying, let's say there's a software on the market that you're using, Excel. Someone did a post on this earlier today. Excel they were using, but then they were having trouble with Excel. And instead of asking an AI to help them with Excel, AI said, well, why don't I just build you another one? So it built a whole spreadsheet software that was specific to that person's company, that integrated with all their systems, and they ran it. The person's like, I don't know a lick of code. And it helped set up Vercel and different systems, and they got it all working out, sending out emails to people, managing stuff, visualizing how it works. And so then you go, well, that piece of software, in a sense, let's say, is as good as Excel, but doesn't have any of the back-end maintenance for the company, any marketing, none of that stuff is there. And so the cost of all that shrinks. So if you had to actually buy your you have to buy a piece of software or whatever just for the cost of the energy and the materials, what would it actually cost? And he says, well, basically nothing. In the same way that when you go to the store and you buy a box of nails, you're not even thinking about it. It's what can you build with the box of nails. But so that can make Bitcoin and a bunch of other assets that are software related worth zero or near zero, while the productivity that Bitcoin blockchain provides is astronomical. Crazy.
Interesting.
Crazy.
It's like if all cars were free, people wouldn't stop driving cars.
And you also wouldn't buy 10 of them.
Right.
It's like such a crazy thing there. Anyways, look, guys, I don't want to belabor the point here. The future is bright. The future is interesting. New institutions seem to be coming into play, and I'm trying to pay attention to what it is. I'm putting my bets on the institutions that I want to be there in the future. So let's see what the next 5 years looks like. For now, trading is one of the ways I find that people are going to be looking for separate income streams. And I'm very happy to be part of the Traders Post team here as we create a tool that it's unbelievable for you in order to help you trade that much better. Get your ideas out into the markets so you don't have to pay a financial advisor, you don't have to pay for mutual funds or whatever. You can just go ahead and participate in the market directly and use this information yourself, and maybe have an agent do it with you as well. So thank you so much for being here, folks. Anything else you want to say, Peter, before we leave?
Remember that there's a ton of stuff happening on this channel. In case you missed it, you're going to want to go to our YouTube channel, click on video, click on live tab. There are interviews, there are shows that are happening constantly. Tom and I were going to be trading together next week. Prop firm
all next week, not President's Day, not Monday because it's off, but Tuesday to Friday it'll be Trade-tastic.
Price Action Live. There's a strong possibility it goes off the rails. All right, it's just Tom and I there, so will we have to pull the episodes down? Maybe. If you catch them live, you'll get to see them. So like and subscribe, hit that bell so you'll be notified when we go live. Thank you so much for watching. Make sure to pay your like tax, and as always, we wish you happy trading.
Happy trading.